QuickBooks Pro Desktop 2021. Customer section, customer cycle. Let's get into it with Intuit's QuickBooks Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You can open the home page by going to the company dropdown, selecting the home page. We also have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list, and making sure that it is not collapsed with this little arrow here, although we will be collapsing it shortly. So now we're going to be going down to the customer section. We're going to look at the flow within the customer section. As we do, we will collapse the home page here, the open windows, so we can maximize our view. So what we want to do all the time when we're thinking about the data entry transaction is, once again, think about the transaction. Does it fit into a standard flow? If it fits into a standard flow, what's the standard form that we will then use? And then thinking about what the effect of that form will then be on the financial statements, on the balance sheet and income statement, and then possibly on supplemental type of statements that will typically be complementary to the financial statements, the balance sheet, and the income statement. Now, the customer cycle, of course, is going to be dealing with the customers to us. We might call it the sales cycle because these are the people we're going to be selling to. We might call it the accounts receivable cycle because if we charge of accounts receivable, or if it goes through the accrual account of accounts receivable, the account that tracks money that is owed to us, then it'll be going through the accounts receivable. 3 names for basically the same type of activity. Now, the flow of the receivable or the sales process could change from company to company. It might have a different item from company to company, and this could have a major impact on basically how you're going to be inputting this information into the system. We'll start off with a full accrual system. A full accrual system means that you're going to be invoicing the clients and will therefore be using accounts receivable. Accounts receivable is an accrual account. If you're on a cash basis, you will not be using accounts receivable because it is an accrual account. If you need to use accounts receivable to track money that is owed to you, then you are on an accrual basis. Now, that will typically happen if work is done before we get the payment. Typically, that'll happen for service type of companies like a law firm or CPA firm, tax firm. The work is done. We have to accumulate the time for the work. We probably have to add it up, do whatever we need to do for the billing process, and then bill them. We don't really know what the bill is until we do the work because we got to add the hours and so much and so forth. And therefore, we bill the client and expect to receive payment in the future. And when that is the case, we need to track that payment and how past due it is so we can follow up on the collection process. That form will be the accounts receivable. There will be the invoice. It will be the invoice, and the invoice means that the accounts receivable will be increasing. So when you think about the invoice, there might be more than 2 accounts affected, but the 2 accounts that will be affected for sure will be the accounts receivable will go up, and the other side will be some kind of sales item on the income statement, recording the sale at the point in time that the invoice was created, because on an accrual basis, although cash wasn't received, the invoice being created is usually closer to the point in time that the work was actually done. As you can think about if you're doing a billing process for if you're billing for work that was done in the past that you did hours on, you're counting the hours, then the invoice is going to be closer to the point in time you did the work, which is an accrual concept, as opposed to when you got the payment, which is going to be further away from the point in time that you actually did the work. Okay, so then of course, if we build someone, we can track the receivables and we expect to receive payment at some future time. Now, that payment could be in the form of an electronic payment, it could be cash, it could be check. But I think the easiest way to imagine is that we send out the invoice by email or by mail, and we expect to receive a check in the mail. Although, again, we could get some electronic payment or set up other kind of payment options and then receive payment at some future point. Now, this one's a little bit confusing, the receive payments, because you could say, okay, from an accounting standpoint, in the accounting world, what would happen if you looked at just financial accounting? From debits and credits, we would debit or increase the cash account at this point in time, and we would credit then the receivable. The receivable would go down because we have now been paid, and they no longer owe us the money. The asset of the receivable would go down, and the other side would be going into cash. However, it's a little bit more confusing in the real world here because cash, there's different cash accounts. Like there's the checking account, which is our major cash account. Did it go into the checking account yet? We don't really know. We might have gotten cash. We might have got some other form of electronic payment. So the question here is, did it go into the checking account? Should I record it as an increase to the checking account at this time? Why wouldn't I record it as an increase to the checking account? Well, possibly if I receive something like cash payments or possibly credit card payments, then I got to be careful about how those payments will be grouped when they hit the bank statement, because I want to be tying out the bank statement to my books when we use the bank reconciliation, which is a major internal control that we want to make sure we take advantage of. So for example, if I received a bunch of cash payments, then if I go to the bank at the end of the day and deposit those cash payments into the bank, then they're going to be deposited in the bank as one lump sum. If I record a bunch of cash payments that were received from different customers in this area, then I'm going to have a bunch of individual cash payments. And when I compare my books to the bank statement for the reconciliation, the deposit amounts will not match. So I'll have to add them up and do some adding up to figure it out. It's possible to figure it out, but it can be quite confusing. If you have credit card payments, credit cards will often group your deposits from different customers in kind of different ways and then put it into your bank account as one lump sum. And you're going to have to figure out, well, how is the credit card doing that? Because I need to tie that out to the bank statement. So that's what this interim step will do. So oftentimes when you go into the receive payment, you will increase cash, but we're going to use this undeposited fund type of accounts. And that undeposited funds type of account is confusing, often a point of confusion and where people get messed up on. But that represents money that has been received but has not yet deposited into the bank, so that we can then deposit it into the bank in the same format as it will be grouped in on the bank statement, so that at the end of the month, we can do a reconciliation of what the bank has recorded on the deposits, comparing that to what we have recorded on the deposits, and that'll be the reconciliation process. So this is the full kind of cycle that we would typically have. Now, if you have a system where you have estimates, then you would have an estimate here, which is kind of like the purchase order in that there's not an actual transaction that would happen here, but it's an estimate, and this would be something for a job cost system, most likely, or most commonly used for like a construction company, you can imagine, where you're estimating what the job will be. No transaction takes place at that point in time, but you need the estimate in order to get the job, and in order then you can use that estimate to create the invoice at a future time. Okay, so what if you're in a type of business where you get paid at the same point in time? And you can think of this at any point where you have the register like in the store, like a restaurant or like a food truck or something like that, where you're going to give you're going to get paid at that point in time, right? You're not going to invoice them for the food that you're going to be giving them or something like that. Well, then you can think about the sales receipt. And you can think about the sales receipt as basically the form that would be similar to like giving a receipt to the customer at the point in time that the sale was made, when you receive payment at that same point in time. So you can see in the flowchart, it's basically bypassing these two areas. It's similar to the invoice, but instead of having an invoice and then receive payments, we're basically going directly here because we're receiving the payment at the point in time that the work was done. So in this case, oftentimes that work being a sale, for us being like selling the guitar. If someone brings the guitar up to the register, we did the work at that point in time. What work was that? We gave them the guitar, and that finished the work. Or if it's a service, if it's like a restaurant, obviously we gave them the meal at that point in time and we got paid at that point in time. Therefore, we would record this item, which would record the same kind of transaction here, but again, it would be distinct. It would differ in that we would be depositing directly, or the increase would go into cash, and the other side would be going to the revenue account. Now, here, if you're collecting money at the point of sale, it's even more likely that you're going to get cash sales. And when you have cash sales, it's more likely that you do not want to put the cash sales directly in the checking account at this stage, because again, you're going to have to go to the bank at the end of the day and deposit it into the bank. And if you have a group of cash, then it's going to go into the bank in the format of that grouping of cash. Therefore, this will typically increase, once again, that undeposited funds, a type of cash account, but not the checking account. The other side going to sales, and then you're going to go over here and you're going to make the deposit, depositing it into your books, recording it in your books in the same kind of grouping that will be seen on the bank statement. So those are the general two kind of formats that you will have. Now, but note, there's also some kind of unusual type of formats that you can have for the customers, and that would be a situation where you get the money before you do the work. Usually you do the work before you get the money or at the same point in time. But some industries you actually get paid first or there are some areas of your industry in which you will get paid first. And some industries like that would include and they're becoming more common right now. The classic example is like a newspaper or a magazine subscription, where someone pays you for a year's worth of newspaper or magazine subscription, and then you deliver the newspapers as the year goes. That means you got the money before you got paid. So that means you recorded this item before you got paid. I mean, you got paid before you did the work. So that's kind of backwards, or obviously it's backwards on the arrow. This is more common these days because applications often work in this case. They're on a service type of basis, so you're going to be paying for a subscription basis, I should say. The customer pays for it before you give them the subscription. They might have a year's worth of subscription or whatnot, and they'll pay you first, but you haven't earned the money at that point in time. So at that time, normally, if you've worked with accounting debits and credits, you would record then the cash would go up. And in this case, we would still probably record it to undeposited funds or directly into the checking account if it's going to be grouped in a format that will match the bank statement. And then the other side will be then going to undeposited funds, which is going to be a liability account instead of income. And then we would have to record the income at the point in time we earned it. Another situation that we will work with in our example, we'll see a couple different situations in our example problem of this, but you might have a situation where you get a deposit before you deliver something. And so like if you have a rental company, then obviously you obviously get the deposit, which is or it might be the last month's rent, and that last month's rent hasn't been earned. And therefore you get the money increase in cash, but the other side can't be revenue because you haven't earned it at that point in time. It's got to be a liability. Same kind of concept. Or if you sell something like in our case, a guitar, then you might get, if they order the guitar but you don't have it on hand and you're going to order it for them, you might ask them for the money first, getting the money, and then, or at least a deposit, part of the money, 10-20% of the payment, to lock them into the purchase, so that you will then be sure that they will follow through when you make the order, and then you can apply that amount that they paid to the invoice. Now there's a little added quirk with that when you work that within the QuickBooks system, because note, when you get the money before you create, you still want to tie it to the invoice that you're going to be making later, because you're going to apply obviously the money that was paid beforehand to the invoice that you're going to be creating later. Typically, you do that, and the system uses this connection with the accounts receivable subsidiary ledger, not usually a liability account like unearned revenue. So that's kind of an issue you'll see, and we'll see that when we go through the practice problem. I won't go through the whole thing on that now, but that's going to be an issue that we'll have to deal with, an added kind of logistical issue that you don't normally see when you just deal with debits and credits, because the debits and credits aren't thinking about the tying to the subsidiary ledgers and matching out the invoice and the payments that need to happen. So if you've dealt with the debits and credits, then you want to take a look at that section so you can see how that would work with regards to matching out these forms, so we can track the forms and the subsidiary ledgers as well as record the transaction with regards to the debits and credits. So that's going to be the basic flow. Then obviously we have down here, if there was a credit memo or a refund, we'd have the refund, which would kind of be like a reversing transaction of the invoice or sales receipt transaction. And also note that the other kind of added factor that can confuse things is going to be if you have inventory. If we're tracking inventory, as we will in our example problem, then the invoice becomes more complex, a lot more complex. Because then you're going to have to track if we're using a perpetual inventory system, and QuickBooks will use basically a weighted average inventory type of system. If we have that and we're using that, then when we create the invoice, it will not only record an increase in sales and an increase in accounts receivable, but we'll also have to record a decrease in the inventory, as well as the expense related to that, the cost of goods sold, and let's just take a look at one here while I describe this. If I invoice and I go back to an invoice, here's selling an inventory item. So notice what's on the face of this is well, they're going to owe us the money here. This is what we charged for it, but we have the sales tax as well. So we actually are going to be receiving, they're going to pay us. The accounts receivable is going to go up by that $399, but then the sales is only going to go up by the $380. And then the sales tax of the $19 is going to increase the sales tax payable. Not only that, but the invoice will have to drive the decrease in the inventory, even though the amount of the decrease in the inventory isn't on the invoice, because we don't want to give that to the customer. We don't want to tell them what we paid for it. And the other side's going to have to go to the cost of goods sold account, the expense related to us consuming the inventory. So we'll talk about this a lot more when we get to the invoice, but the invoice is actually somewhat complicated when you deal with inventory in particular. And that's good to know, but also if you set it up properly, then when someone enters the invoice, they don't need to know that much. The data input, in other words, is very easy. If you're going to have someone do the data input, no problem. If you were to ask somebody what's going to happen to the financial statements when you record this invoice, they probably wouldn't be able to know. They wouldn't know what to tell you. But if you ask them to just simply create the invoice when necessary and track who owes the money, if you have the system set up right, they can do that. We could do that without knowing exactly what the effect is on the financial statements, and that's kind of the point, to separate the logistics of just simply the data input and the setting up of the system, and then the analysis of the financial statements and the creation of the financial statements. So the same is true for the sales receipt, of course. If we're selling items, inventory items, if I open up the sales receipt, it will look very similar here, except that the sales receipt means that we're going to increase cash, not accounts receivable. Cash meaning either the checking account or undeposited funds. So we'll take a look at more at these two items shortly, and we'll just analyze them. And then again, when we work through the practice problem, we will of course create these, and we'll check out every time as we go through these items. You want to ask the same questions. As I record a transaction, where does it fit in terms of the flow chart? Once I know where it fits, what's the correct form that I'm going to be using? Once I know what form to use, what's going to be the effect on the financial statements? The financial statements of the balance sheet and the income statement or profit and loss statement, and then possibly what's the impact on any sub-ledger accounts, such as the accounts receivable or inventory subledgers. We'll get into that in the future.